At the very center of technology, finance, and geopolitics sits a single company, SMIC, China's semiconductor cornerstone. To understand its path forward is to understand a critical piece of the future global tech landscape. Because if you know how to read the numbers, its financial statements tell a story that goes far beyond quarterly results. It's a story of a national strategic imperative meeting the realities of market dynamics. Let's decode that story. Our entire analysis is built on three core pillars. First, SMIC's growth engine is decoupling from the global semiconductor cycle. It's being driven by domestic demand. Second, its role as a key national asset has just been solidified through a major internal consolidation. And third, the market's reaction to that move has, in our view, created a significant valuation discrepancy. We'll begin with that consolidation. So let's start with this pivotal acquisition. This single move tells us a great deal about SMIC's core strategy, which is all about consolidating absolute control over its most vital assets. The transaction in question is SMIC's move to take 100% ownership of its subsidiary, SMIC North. Now, you have to understand, this isn't just another division. SMIC North is the company's R&D heart. It's the engine room for all of their advanced process manufacturing. Simply put, it's where the future of the company is being engineered. And this move immediately created a fundamental conflict in perspective. On one hand, the long-term strategic logic is perfectly clear. It gives them total control of their core asset, it aligns perfectly with China's national tech goals, and it strengthens the bond with their key state-backed investor. But the market reacted to the short-term mechanics, specifically that the deal was funded by issuing new stock at a deep discount, which sparked immediate fears of shareholder dilution. This tension is central to the entire SMIC story. Now, a move like this cannot be understood in a vacuum. You have to zoom out to the broader geopolitical battlefield where SMIC operates. And you'll find that the primary weapon being used against it is, in fact, a double-edged sword. The U.S. export control strategy has been methodical, layered, and has escalated over time. It started with the initial entity listing. Then came specific tech limits targeting advanced manufacturing equipment. The next step was coordinating those restrictions with key allies, namely the Netherlands and Japan. And the final layer was extending these controls to cover products made anywhere in the world using U.S. tech. And this is where that double-edged sword metaphor really comes to life. The sharp edge of the sword is undeniable. It effectively blocks the company's path to the most advanced sub-7 nanometer nodes by denying access to EUV equipment. This widens the technology gap with the global leaders. But here's the other side of it. The handle of that sword has become a powerful catalyst. These very same restrictions are forcing Chinese tech companies to de-Americanize their supply chains, creating an enormous, protected domestic market that is structurally funneled directly to SMIC. So with that context, let's turn to the financial data. Because to really see the effects of this dynamic, you have to look beyond the simple headline numbers. On the surface, the top-line number for Q2 2025 looked weak, a sequential revenue decline of 1.7%. Now, for many, that negative figure might signal that the company is struggling. But that headline number obscures a much more important story unfolding underneath. Because in that very same quarter, the company generated over $1 billion in positive net cash flow from operations. This isn't a minor detail, it's a massive reversal from the prior quarter. It's a clear signal that despite a small revenue dip, the core business is an incredibly powerful cash-generating engine. That points to very strong underlying health. And if we break down where that revenue is coming from, we see another strategic shift underway. Yes, consumer electronics and smartphones are still the largest pieces of the pie, but the real growth story is in the industrial and automotive segment. This is a higher value, stickier market, and it shows a successful push into more demanding applications. And this, right here, might be the most telling metric of all. A capacity utilization rate of 92.5%. Now, according to the company's own management, this essentially means they are completely sold out. Their factories are running flat out. This isn't a sign of a company buckling under pressure. This is direct, quantitative evidence of that protected domestic market firing on all cylinders. The demand is simply overwhelming the available supply. So all of this data, the strategy, the geopolitics, the financials, brings us right to the central debate. How do we value this company, and what are the real risks and counterarguments we need to consider? Now, for a company like CIMIC, which is in a phase of enormous capital investment, where earnings can be volatile, the traditional price-to-earnings ratio isn't the best tool. We prefer the price-to-book ratio, which anchors the valuation to the company's tangible net asset value, giving us a more stable picture. When we compare SMIC's price-to-book ratio to its peers, it occupies a very interesting middle ground. At around 3.5 times book, it's valued far higher than a mature node player like UMC, but it's still well below the undisputed advanced node leader, TSMC. And this positioning is really the core of the valuation puzzle. So the crucial question becomes this. Is the market valuing SMIC as a really good, but ultimately limited manufacturer of older generation chips? Or is it beginning to price in the unique strategic value of its position as China's only scalable platform for advanced semiconductors? The answer to that determines your entire perspective on its valuation. Of course, we have to consider the counterarguments. So let's play devil's advocate. First off, has the market already fully priced in the national champion narrative? Is the current valuation already reflecting a premium for its political importance, leaving little room for upside? Second, and this is a big one, is the technology gap a permanent trap? If export controls create a hard ceiling on how far SMIC can advance, what is its ultimate long-term value, no matter how strong domestic demand gets? Can it ever truly break out? And finally, let's circle back to that SMIC North deal. Was the market's initial negative reaction actually the correct one? Did the short-term pain from shareholder dilution outweigh the long-term strategic gain? It's a fair question to ask. To track these risks objectively, we have to define specific thesis killers, data points that would tell us our core analysis is breaking down. Financially, we're watching for gross margins falling below 18% for 2 straight quarters. Operationally, it would be capacity utilization dropping below 85%. Strategically, the emergence of a true state-backed domestic competitor would change the game, and geopolitically, any new sanctions that block maintenance for their existing equipment would be a critical blow. These are the signposts to watch. And this leaves us with the ultimate question, one that encapsulates this entire analysis. Will SMIC's future be defined more by its powerful geopolitical mandate, which has created this massive protected market, or will it ultimately be defined by the hard technological limits imposed upon it? The interplay between those two opposing forces will determine the future of China's semiconductor cornerstone.